Novo Nordisk and Eli Lilly have been locked in a fierce battle for dominance in the booming GLP-1 market, the drugs behind Ozempic, Wegovy, and Mounjaro. But lately, it's been a tale of two very different charts. Novo Nordisk, trading under NVO, is having a rough year, down nearly 40% year to date, and more than 50% over the past 12 months. Meanwhile, Eli Lilly is holding up better, up about 6% year to date, though still down a bit over the year. With earnings just around the corner and even politicians piling into both stocks, the big question is, which one is a better buy right now? So as a CPA, I'll break down the numbers so you don't have to, and if you enjoyed the video, drop a thumbs up and subscribe to the channel, and with that, let's dive right in. The GLP-1 market is booming, driven by huge demand from people with type 2 diabetes who use these drugs to control their blood sugar levels. But here's where it gets interesting. You've probably heard of the most popular brand name, Ozempic, and how it's been flying off the shelves. That's because one of its biggest side effects is weight loss, and that's turned into a global craze. Now, even people without diabetes are using it to shed pounds, creating an entirely new market that no one saw coming. Whether that's a good thing or not is up for debate, but one thing's for sure, it's bringing in record-breaking revenues for drug makers like Novo Nordisk and Eli Lilly. According to a recent Goldman Sachs study, the anti-obesity drug market is expected to skyrocket to nearly $120 billion by 2035. And here's the kicker. Most of that growth is projected to come from out-of-pocket spending, meaning people are willing to pay for these drugs even without full insurance coverage. Now, Goldman also gives a 50% chance that Medicare access could open up for these medications in the coming years, and if that happens, it would massively reduce costs for patients and could send sales for companies like Novo Nordisk and Eli Lilly even higher. Alright, let's dive into the companies. Starting with Novo Nordisk, looking at the chart, a few things stand out. Over the last 5 years, revenues have been climbing steadily, growing at a 22% compound annual rate, to reach around 423 billion in Danish krone, which in USD is about 65 billion. Now, net income has also been on the rise, hitting 111 billion in Danish krone, about 17 billion USD, with a 24% CAGR. The only red flag here is a slight dip in gross profit margin, from 85% down to 84.3%, likely due to rising medical and production costs across the healthcare space. So financially, NVO looks solid, but the stock tells a different story. Despite strong numbers, the share price has been sliding, and that's where future guidance comes in. Back in September, Novo Nordisk slashed its full-year outlook and announced a massive 9,000 job cut, the largest layoff in Danish history, citing intense competition from Eli Lilly and a growing wave of copycat GLP-1 drugs that were hitting the market. And as a result, the shares have been coming down ever since, so Q4 will be really important for the company when they report earnings. Now, moving over to Eli Lilly, the story here has been one of steady growth. Over the last 12 months, the company pulled in about 67 billion in revenue, growing at an impressive 18.8% CAGR. Next, net income has climbed to nearly 14 billion, with a 19.5% CAGR, and their gross margin has improved to around 82.6%, so solid profitability all around. And with those kind of numbers, it's no surprise the stock has been on a strong uptrend over the past 5 years. Though it's been consolidating recently as it moves sideways ahead of earnings, now all eyes are on the next quarterly report, where analysts will be watching demand for their obesity drugs and tracking clinical results from new drugs in the pipeline. And here's an interesting angle. Unlike Novo Nordisk, which is based in Denmark, Eli Lilly is headquartered right here in the US. That could play to its advantage, especially with the current administration's push for domestic manufacturing and healthcare innovation. It's a small but meaningful factor that could give Eli Lilly a home field edge in this growing market. Finally, let's break down valuations. Novo Nordisk is currently trading at a trailing PE of just 13.7, which is well below its 5-year average of 34. That means the stock is sitting at a massive discount compared to historical levels, potentially an attractive entry point for long-term investors. Eli Lilly, on the other hand, is trading at a PE of 53.95, slightly below its 5-year average of 65. So while it's not as heavily discounted, it's still a premium valuation, reflecting steady growth and strong investor confidence. Analyst price targets also tell a compelling story. For Novo Nordisk, the average price target is $60.51, which represents about a 14.3% increase from the current price of $52.96. Meanwhile, Eli Lilly has an average target of $898.04, roughly an 8.9% upside from its current levels of 824.45. Based on all this, I'd say Novo Nordisk carries more downside risk right now. There's a lot of uncertainty around future growth, and the recent board overhaul, pushed by one of their top investors, that highlighted concerns about the pace of change at the company. But if things fall into place, Novo Nordisk could also offer one of the biggest upside potentials, given its historic dominance in the market. Now, as for both stocks, analysts still rate them as strong buys, which aligns with my view. If you're thinking 4 to 5 years down the road, Novo Nordisk could be the better long-term bet. But if you prefer a more stable US-based play, Eli Lilly benefits from domestic support and could continue to boost its bottom line and become a preferred provider of GLP-1s. So friends, if you enjoyed the video, drop a thumbs up and subscribe to the channel. Let me know your take on Novo Nordisk or Eli Lilly in the comments below. And as always, thanks for watching. I'll see you in the next one.